I'm Eric Chemi, and this is Politely Pushy. Hey, Michael, thanks for joining me today. I know Kiavi focuses on loans for real estate investors, and my wife has been watching way too much HGTV. She thinks she's going to be a flipper one day. She has a lot of crazy ideas in her mind. So hopefully after this conversation, I can help set her straight. So first off, is it Michael or is it Mike?
Michael would be great.
So what does Kiavi do? Are you guys a bank itself? I know you focus on investors, but how does this actually work?
Yeah, no, thanks, Eric, and thrilled to be here. Kiavi is actually a tech company that happens to be one of the largest lenders to real estate investors in the country. And so we use data and technology to really provide real estate investors with innovative financing solutions that helps them make informed decisions, helps them close their deals fast, helps them build and grow their businesses ultimately. And so it's super interesting space, and our customers are really focused on trying to kind of fix up and revitalize the $25 trillion of housing stock in this country that's more than 30 years aged or more, providing kind of move-in ready homes for folks, as well as rental housing for millions of Americans. But long and short of it, we're not a bank. We can talk more about that, but that's who we are.
So help me clarify. So you're not a bank, because I'm not an expert on this stuff. So you're not a bank,
Sure.
but you are the lender though, right? So it is your money that you're lending out.
That's correct. So we're the lender. We finance the business different ways, but ultimately give our real estate investor customers the benefit of accessing kind of institutional capital, which helps drive really efficient kind of cost of funds for them. And so we are able to we've been able to develop our own kind of underwriting standards over the years. It's really not a bank product. It's not governed by any of the typical folks you see in the housing space like Fannie or Freddie or the GSEs. And so ultimately, what we've been able to do since the company was founded in 2013 is really, through the completion of over 35,000 transactions now, identify the things that really matter in one of these transactions, and then devise our operating processes and our underwriting standards around that. So we can ultimately pick out kind of the true signal and the noise of the things that matter in one of these transactions, and then originate loans against that. And over time, we've really proven kind of our capability at this, and in so doing, have really been able to, make the ultimate investors who are buying kind of the cash flows from these loans very happy. But importantly, and most importantly, give our customers, a great experience, a fast experience, and one that they can kind of rely on as they, themselves are really entrepreneurs building and growing their own businesses.
So when you say the data that you're looking at, these certain things that are not the noise, right? The signal, not the noise in terms of these transactions. So in the past, we would think about FICO scores, for example, or we'd think about, okay, what is the rental income of this property going to be? Or what is, those basic kinds of categories. Are those not as useful? Are they actually completely useless? Are there other kinds of data? Can you share examples of, hey, this is the type of thing that is the new signal in the year 2022 that in the past people hadn't looked at, but it's actually useful data?
Yeah, no, I think it's a great question. And when you think about, let's talk about a fix and flip transaction for a minute. You have really three dimensions that are going to matter. You have the home itself and what the real estate investor wants to do with it. You have the real estate investor and their credit worthiness, and then you have the market that they're operating in. And so there's three very different dimensions that you kind of have to solve for to get correct. To make sure that you're helping them make a good decision. And so things like FICO matter, but it's not determinative. And we found that there's other indicators in addition to that, for instance, that can help identify creditworthy customers who might be limited by a traditional FICO score, and in so doing, allow a bigger population of real estate investors to have access to our loan capital. And so that's one simple example. I think if you stripping it back to maybe a tangible example, one of the things that we realized a few years ago was around bank statements. And so it's common. Okay, you're going to do a loan. You're going to underwrite the borrower. I need bank statements, and I need a couple months worth. And there's stuff in there. There's ending balances. What our teams were able to do is basically rip it apart and confirm that there's no actual predictive benefit from the presence of bank statements, the presence of any balances in the bank statements, the activity through there. And so what we were able to do is just eliminate those from our process, taking out a major pain point for customers who have to go get their own statements and then answer questions back and forth. And what we realized is it saved about 4 or 5 hours of processing time for our employees who were kind of working through those and and asking questions back and forth. And so that was a relatively simple example where we were able to simplify things for our customers, make the process more streamlined for our employees, and also, not change kind of the overall performance of the loans.
That's a pretty big one though, right? To say we don't need bank statements because everybody wants bank statements. So is it because the data in there, or the numbers are right? People just put numbers, they can move money around to make the bank statement look like whatever they want it to look like? Is it because there's other transaction data that you want instead? So I'm curious both. I know we'll get off this tangent in a second, but I'm curious, as a good example, what's in it in the bank statement that is useless, but what do you do to replace it to try to get the information that the bank statement supposedly was trying to get to?
Yeah, no, I think look, you still go through, kind of the know your customer requirements that are common in financial institutions. And so the presence of bank statements in some ways was meant to support that. But you're right, like, there can be money in, there can be money out. It's not necessarily, like one account for one home or for one investment property. And so it just wasn't, I don't think it was the best signal. And so what we've been able to do is look at things like, FICO, customer experience, the history that they have and the success that they've had renovating certain projects, that have proven to be better indicators of ultimate success that we can rely on to a greater extent than just the presence of a bank statement, for instance.
That makes sense. That makes sense. So you're not a bank, so it means you're not taking deposits. Obviously, that's the big thing about a bank. So where does your money come from?
Sure. So the company got started, traditional kind of venture capital backed company, and over the years we've been able to, change our funding model. And so, at the early stages of the company, it was more of a peer-to-peer approach. So a retail investor could come in, buy a fractional piece of a loan and participate in the performance of that
Peer to
loan.
peer. Yeah, that was such a big thing like 5, 10 years ago, right? Like, oh, you can just be the lender. Yeah, exactly. Okay.
Yeah. And look, it was helpful for the company at the time because it got us started, right? It gave us access to capital. The more transactions we could do, the more performance we could prove. And then that opened up more doors for us. And we were able to launch a fund based on that original performance and use that to purchase loans. And then we started selling whole loans to large institutional investors, big firms that you'd recognize. And then ultimately now we securitize loans. So, every 3 or 4 months, we'll do another securitization. It gives us a fixed funding cost and really just a laddered out pool of capital for a couple of years that our customers know that, we're going to be there for them when they need us to fund their loans. And it's also incredibly competitive from a cost perspective.
So if I'm a investor, right? Let's say I want to do a fix and flip or I want to have a rental property. Why do I go to you guys as opposed to my local bank or a big national bank? Are the loans, are they different? Are your rates better? What makes you stand out?
Yeah, so good question. Maybe I'll talk first about banks versus non-banks and then get into Kiavi a little bit. So, if you think about this space, traditionally it's been served by kind of local, private, or hard money lenders. And they're really characterized by more old school, traditional offline processes. It could be, they work with local contractors, they have local knowledge, and they make, decisions based on, paper coming in and a credit committee or something like that. That's really been how the industry has been funded for a while. And so think about 10, 15% interest rates. And that was just how it worked. Not very scalable, not distributed across different markets. And so over time, this really has proven not to be a big bank product either. You don't see the large, big money center banks participate here. Again, they don't really have an advantage. It comes down to the data around those 3 different areas that I talked about being critical to make decisions. That's not something that they have their hands on. You can't just go out and buy access to this information today. You do see some small community banks participate in the space, who may have a mandate to reinvest a certain percentage of their deposits in kind of local investment and things like that. But it's really not, done at scale. And so why, customers like Kiavi and they appreciate, working with us is we make things simple for them. Everything's online. It's all, something that they can do at night, on the weekend. Entirely online. They don't need a person to be there on the other side. It's transparent for them. Right in our online funnel, they can see rates and terms, and they can adjust the parameters of their transaction accordingly to suit their needs. And then ultimately, as they, if they're working on a renovation project, they'll input very structured data that says, 123 Main Street, I want to do this to the kitchen, I want to do this to the floors, I want to do this to the landscaping. We can help them optimize, that project. And so help them understand, okay, they might be doing too much or too little for kind of the optimal outcome for that home in that area, and help really set them up for success. And so what's interesting is that on average, it takes probably 18 or 20 days to close a loan. For our more professional borrowers who really repeat with us, we close loans on average in around 7 days. And just a few weeks ago in December, we had a customer submit a loan with us on a Sunday, and we funded that loan on a Tuesday. And so it really gives you a sense for the kind of speed that we can operate under in this hot real estate market, especially. That's really important for our customers.
I like what you said there. They can upload the information and the system will say, hey, you may be not doing enough work on this, or maybe too much. So I want to talk about that, because I would love to know if there's a system that says, hey, this is exactly the formula for success, because that's what everyone's trying to figure out. And it feels like so many people right now they're watching HGTV. They think they can be flippers, or they've got all this extra money. And there's a lot of new people getting into this space. So what is it, as an example, what are some mistakes that rookies make here? What are some data points that are examples that you have that you've just seen, you've been surprised about by learning, but, oh, these are the kinds of fix and flip projects that you want to do, and what do you want to avoid? I know I've asked a lot there.
Yeah, no, it's a great question, and the secret sauce, right? It's how do you make sure this is going to work? And the stripping everything away to, the simplest point is you got to make sure whatever you're going to do, you're going to hit your timeline, because assuming you set the project up right from the beginning, if it takes a couple extra months, that's a couple extra months of taxes, interest, and insurance that you have to pay. That's going to eat into your returns. It also means the market could change and things like that, relative to if you want to get out in the summer or in a certain time period. And so it's really important that you can hit a schedule. And so a common mistake folks make is they will maybe underestimate part of that process. It could be the upfront permitting process. It could be the availability of contractors, or now that we've seen some supply chain challenges in the country in the last year, it could be availability of materials. All of that can play in. And if you have just a couple of those things that stack on each other, the project can extend out, and that can really erode returns. In this environment, given just the home price appreciation people have seen, it hasn't really hurt people to the extent it might have in years past. But that's probably the biggest challenge people face. I think it's relatively straightforward to look at somebody's plan and bounce it up against the data that we have to identify, does this feel right? Are they trying to do too much in this home that really is going to be way overbuilt for the neighborhood it's in, or is there more of an opportunity to invest just a little bit more to get a better outcome? What's interesting about our approach is we're partnering with local real estate investors, right? They know their neighborhoods, they know the areas they're in, they know they have a sense for what they think is going to work, and then we're able to bounce that up against what our data says. And so together you have a view that's really informed by boots on the ground with years and years of data to basically say, look, we think this collective investment is ultimately what's going to set you up most for success and guide the customer that way.
You always hear those stories about, hey, put your money in bathrooms, or don't waste it on the roof, or it's the deck, or it's the HVAC, the stuff that people can see versus what they can't see, or don't waste money on closets. You hear all that. Is that the kind of data that your system has?
Yeah, so we can tell you, the different combination of factors that might increase risk or increase return. I think HVAC could be the right answer in some environments, but that's typically a tougher payback.
If people can't see it, it feels like you got to do the stuff that people can see, because that's what they'll spend money for, not just behind the scenes infrastructure.
Yeah, look, it's kitchens, bathrooms, kind of entryway. A lot of paint, flooring. Those are kind of the most typical investment areas.
Do you waste money on landscaping outside and the painted color of the house outside versus all the inside stuff, right? I know you're hiding all that info. I mean, you got it all in your head somewhere, right?
Look, it's situational dependent.
Is it really based on like what locality you're in? What are you in the north or the south, or are you in the east, west, coast versus the middle of the country? Does that really truly affect the right answer for a lot of this stuff?
Look, it really does. And what's interesting is you can, we're working on some different kind of enhancements to our products that really can help give people more information at the time they're thinking about an investment decision. And a simple example is, being able to go down to kind of a zip code level and say, okay, if my entry point is this price per square foot, I can look at all the transactions done in the last year, understand how much they spent per square foot, and ultimately what that realized in terms of gain. So it may not tell you, do kitchen, not bathroom, or entryway, or landscaping versus roof, but it can tell you if I can keep my renovations within these parameters and give me kind of that value creation function that'll match kind of what's been done historically. Like, that's a good data point for people, so they can kind of have some parameters to go in and then work with their design team or whomever they're working with to help lay out the renovation. Look, this is the box I want to work within. Help me get this right, and ultimately position that project for success.
Right. So obviously that's what you're trying to do. You want to position projects for success because that's going to get your money back, right? You want people to be able to make money, pay you guys back, do it again because they were successful the last time. Because this is clearly different from a bank product, because I don't think the bank really cares or gets involved in any of this. It's just like, we gave you the money, we want it back, and good luck to you.
Right. And if it doesn't work, they're happy to take the property back and sell it that way. Like, that's not how we operate, right?
You don't want the property, I assume. You don't ever want to touch that.
Yeah, look, if we have to, we will. But what's interesting is in any given month, about 80% of the transactions we do are with customers who are doing a repeat transaction with us. And so it's in our best interest to make sure the customer succeeds, because when they do, they come back. And one of the interesting things that we've been able to determine, looking at the data from last year, is 92% of our customers' projects made money, which is great. That compares to probably 72 or 73% for the industry average. So if
you're looking 15% alpha from what you guys are doing.
Yeah. And so if you're given a choice, you get very competitive rates. It's fast, it's easy to work with, and you're being set up for a better outcome. That's the value proposition that we offer our customers, and why they keep coming to Kiavi, and why we're growing so quickly.
So who's your competition? It sounds like it's not the banks, but are there other fintech firms doing something similar?
Not from fintech. There are companies out there like Upstart, Affirm, that are taking a machine learning and AI enabled approach to credit decisioning, and so we have they might be doing it on personal loans, and they're looking at one dimension, right, which is that consumer credit worthiness. Whereas we're trying to work across the customer, the property, and the market they're in. If you think about who we're competing with in the space, it's really those traditional kind of private and hard money lenders. You do have some larger regional players that have popped up, companies like Lima One, Rock Capital, to name a couple. But what we found is, they're still really driven by traditional processes and techniques, a little bit more old school in the approach, and not leveraging technology, the way we are.
And your focus on real estate investors, does that mean exclusively investors? If I wanted to come and get a mortgage for the house that I'm living in, or if I want to refinance my own home, would you even allow that, or it's a no-no?
No, it's only for investment purposes. So none of the loans we do are for people that are going to live in the home. These are short-term mortgages for people that are going to fix and flip the home. We do offer a rental product. So for our customers who want to build up buy a home, renovate it potentially, and put a tenant in there, we do have a long-term mortgage for that. But again, it's not for them to live in.
So talk about the name change from Lending Home, because now you're Kiavi. Not that long ago, you were Lending Home. That I think was the original name of the company when it was founded almost 10 years ago. Why the name change recently?
Yeah, no, it's a great question. Look, Lending Home is a great name for us, and I think really built some great brand equity with our customers, and given the track record and the experience we've been able to provide them, that's been very understandable. I think really there's two reasons. One, it's somewhat limiting. As we think about Kiavi and what we want to do in the future, it's really about helping find additional ways to bring products and services to real estate investor customers that help them succeed. So lending is a part of that, but there's other things like analytics and potentially other products that we think we can bring to help set them up for success. And so, being beyond a lender, I think having a name like Lending Home is somewhat limiting. And then, the second thing is it's a crowded space. I think you can go out there and Google companies that start with the name lending, and you'll see, quite a few names out there, and it's not really, who we are. And so I think the name,
I'm sure Lending Club, I'm sure you don't want to be confused with Lending Club, because they always pop up, or Lending Tree. That's another one.
Yeah, both of those names are companies that a close family member asked me, hey, how are things going at Lending Tree? How are they going at Lending Club? And here I am, CEO of the company, 3 years in, and a close family member still can't get the name right. What does that mean if you're a customer trying to remember that name of the company you met at that conference? And so look, we're really excited about the name change. I think the name Kiavi comes from the phonetic kind of representation of the word key in Italian, Kiave, which kind of is really how we're thinking about it. You know, we can help be the key to help real estate investors unlock the aged value in so many American homes.
How long did that name process take? Did you get one of those big name marketing firms? They had to research all the possible, because it's clearly a fun new, it's a modern techie kind of company name, right? So how long did that process take? Did you have, 100 names to pick from and a big filter?
Yeah, we did have a firm help us, and they were terrific. It was branding business if anybody's looking to change their names, but we went very fast. They cautioned us that we were maybe trying to go too fast, but we started in earnest, I think, in February and in March, and went through the process, and then kind of settled on the name this summer, and then you have the graphics that come in behind it, and then that have to work through all the rebranding elements, but. It was an interesting process, a lot of names. I'm not going to say what the other finalists were, but it was interesting for sure.
Who had the final say? Was it you as the CEO? Was it the board? Was it an employee vote? Like, what is it? Was there a finalist? Was like, all right, it's going to be Kiavi or it's going to be this other finalist? What was that final, actual tactical decision like?
Yeah, so we had a small team of folks in our marketing and design teams that were working very closely with the agency. And they, I would have input there and kind of steer them, and they work very closely together. And then I think we all kind of realized we love this name. And so when we took it, I first took it to Matt, one of our co-founders, and I took over from him as the CEO last year, or I guess in 2020. Make sure he was good with it first, and then we took it to the board. But they were very supportive. I think there was a lot of excitement around it, and loved the positioning of it.
And now your family members, when they ask you, how's your job, goes like, no, I don't work at any of those companies. I work at Kiavi now. So don't get this wrong anymore.
Yeah. Now they just say, how are things at work?
At work. That's it. Forget it. But it feels like everybody right now is becoming a real estate investor. Like literally all of my friends, I live in North Jersey. Everybody I know now, they've got a rental property. They're doing a fix and flip. And it's people that I'm not sure they know what they're doing. I'm sure they have any experience in this. These are colleagues of mine from the media space that now are doing this stuff. Do you think there are too many people doing this, and maybe people that don't know what they're doing?
Look, I don't think so. I think the amazing thing about real estate is that it can be accessible to anybody. And if you do it right, there's a real opportunity there, proven over decades, to help generate wealth for yourself and for your families, and to really create a legacy. And so that people want to do that, I think, is inspiring. What's interesting is there are a lot of real estate investors out there. You've seen, a tremendous amount of wealth creation through the pandemic, which has certainly benefited the asset owners and kind of the middle and upper classes. But you've also seen folks on the lower end of the kind of socioeconomic spectrum have bigger bank balances than before and have bigger savings accounts. And so people are looking for opportunities that make sense to them to continue to try to build wealth and grow wealth. And so look, we don't encourage speculation. We don't think that's what any of our customers are doing. And we really view our role as trying to help them be positioned for success. And so what's interesting is we can support somebody who's a professional real estate investor, and we'll do 100 transactions in a year with us, as well as somebody who is approaching it for the first time. We give them a very different experience, and there's a little bit more guardrails, but ultimately we want to make sure, again, that they're set up for success.
I've got a friend or a neighbor. They used to be their own contractor, their own home builder. And then they got a job working for a private equity backed firm who would go around on an institutional basis and just buy up single family homes so that they would either flip them and sell them, or they would rent them out. And he was saying the prices are getting so efficient now because guys like him are working for these companies and they know exactly how much the house should cost and exactly how much they'll spend on the improvements. And he's saying they're just driving up all the prices. So you can't find a deal. You can't be a normal person, even just to look to buy a house to live in, because someone is willing to pay a little bit more. Are you noticing that trend? I mean, obviously we know housing prices are going up, and we know there's a bigger proportion of institutional ownership. And you hear these phrases, hey, we're going to all be a nation of renters at some point.
Yeah. Yeah, no, look, it makes for a good story, and I think the press loves it. This is a perfect press
kind of question, right? That's exactly the kind of emotional narrative you got to jump on.
Buying all the houses. But look, the reality of it is the majority of owners of rental homes in the country is still mom and pop landlords by a large degree. And so I think if you look across, and I haven't seen the final numbers from last year, but probably around 10% of homes purchased were purchased by some of the bigger firms, versus smaller mom and pop landlords that might own one or two, or kind of smaller business folks that might own between 2 and 10. And so it's still very much kind of a local game where people are looking for opportunities in their area, and again trying to build wealth in their neighborhoods and where they know. The thing about institutional capital is look, you've seen, I don't know, a dozen companies pop up in the last 15 years that didn't exist before that are now worth I don't know, collectively 80 to 100 billion dollars, because they've built up these big kind of rental portfolios. But it's really just being driven by kind of the chase for yield and return. And so as interest rates rise, as market demographics change and dynamics change, that's a group that will kind of follow the yield, and I don't think it'll be like that. It'll be like that forever. You're certainly seeing markets like Phoenix and Austin in particular. I think I was looking at something yesterday. Investors bought 40% of the homes for sale in Phoenix last year. Like, that's really high. Historically, the number's been closer to 25%, just given how many people buy there for second homes and investment properties. And look, it's not going to sustain. And so I think it will revert to more to the mean at some point.
Is there a interest rate that you guys make more money on? Do you want to see higher rates? You want to see lower rates? Are you funded a certain way? Because you mentioned interest rates. We know they're going up. Is there somewhere that Kiavi in particular is hedged around a certain number?
Yeah, I think, look, the short-term nature of these loans, they typically pay off in about 8 months. They're a 12-month loan, but they pay off early. Means that our customers are less sensitive to interest rates than you might be on, say, a 30-year mortgage. Historically, this space has seen double-digit interest rates and a point or two of fees, and so that's come down over the years as our cost of capital has gotten more competitive, and we've been able to pass that benefit on to customers. How we fund the business is through these securitizations that I mentioned, and for us, it's fixed cost laddered out for multiple years. So what's interesting today is that even though rates are rising, we might do a securitization, or the securitization that we did last month replaced a securitization that was higher cost from a couple of years ago, just given how much our performance has continued to improve over years. So even as rates rise for the next, say, 12 to 24 months, we could still be in a position where our blended cost of capital is going down, just given how we funded the business. And so we're really excited to be able to use that advantage to pass additional savings on to customers if the market moves higher for other participants who don't have that same funding structure and advantage. Again, give us an opportunity to continue to win more business and serve more customers.
And so talk about your background, because you worked at GE for a long time, up that CFO track. You worked in the healthcare sector, energy, power. What do you bring from that experience coming into Kiavi, which is clearly a much smaller company?
Yeah, look, I'm so grateful to have had a chance to start my career there, and still so many great memories. I could talk for days about my time. I think there's, seeing kind of some of the things you wanted to hit on today, I reflected on maybe three anecdotes that stood out to me over the years that I've really taken to heart, and I think are part of how I think about leading today. The first is a phrase, I'll believe it when I see it in the numbers. And so this was something that one of our vice chairmen said to me. We were in a meeting, it was in the energy business, and we were really trying to improve our receivables collections, and all of our customers were in the emerging world, and Venezuela and Angola and some of these hot spots where it was tough to get cash out. And I was explaining all of the good things that we were doing, and how hard we were working, and he just stopped me and said, "Look, Michael, I'll believe it when I see it in the numbers." And so for me, that really hit home that effort matters, but it's really about impact. And so how are you doing, is what you're doing every day going to translate to impact, and can you measure that? And so that's something that has really stuck with me. The second example was around more my personal development. I was, Lynn Colpeter was a longtime kind of divisional CFO at GE and NBC Universal, and I worked for her in energy, and she's charismatic and funny and tough, and we were talking about things, and she said, "Look, dude, you just got to smile more." And so she said, "Look,"
she said that to you?
Yeah, she said this to me. You should have seen me back then. But she said, "Look, you come out of meetings and everyone's trying to take your temperature based on how you're walking down the hall, and if you're in a good mood or a bad mood. And look, if you're going to be a leader, people are always going to look for you for signal." And And ultimately, the more you let out, look, I'm an introvert, I'm not used to sharing, the more people will develop kind of rapport and relationship with you. And so that's something I've continuing to work on. It's not the easiest for me.
So are you faking this smile this whole time then?
No, I've learned over the years. That was maybe a decade ago. It's taken a lot of practice, but I'm happy to be here, Eric. And then the last anecdote, if I could share one more, came from one of my earliest managers while I was on the audit staff and the finance track that you mentioned. A guy named Ralph. I was explaining some really complicated audit issue at GE Aviation, and he just stopped me and he said, "Look, Michael, I want you to explain this to me like I'm an 8-year-old kid at a lemonade stand." And you take something super complicated and you try to do that, and you just start ripping things out, right? And you rip out the things that really aren't essential. And so at the end of it, if you can actually do that and explain a complicated issue in a way that's easy to understand, that's the essence of a great communicator. And so I think he was saying it a little bit off the cuff and trying to just get me to slow down, but it stuck with me all these years. The more you can do that, the more people can understand what you're up against, the more people can help you, solve those challenges. And so anyway, those are 3 examples from my time at GE that have stuck with me. And, it was a great place to begin my career.
If for an introvert, you've been talking with me for half an hour now. That's pretty good. So
I'm going to need a nap after.
maybe you'll be okay sharing this, because if you're not that great at sharing, but this will be good practice, personal practice for you. And maybe this is the introvert in you. You left California recently. You're in Montana now. I don't know if you're in Montana right now, but you moved to Montana. Is this because you just said, I don't want to be around anybody? Or I guess everyone's moving to Montana from California now. So it's kind of a trendy move. Is this because all your data at Kiavi said, hey, I need to go start flipping houses in Montana? Why that big move?
Yeah, no, look, as do many people that kind of start out at GE, we moved around a lot over the years. And for us, family, our home has always been kind of where our family is, my wife and 2 teenage boys. And we loved the Bay Area. It was our first time being on the West Coast. But after 6 months cooped up in a small home, in the Bay Area with 2 teenage boys, 3 dogs, it just got to be too much. And, really we're grateful that we had the flexibility and the means to be able to go try something different. And so we did move to Montana. It's been wonderful. Montana's amazing. All the things you hear about are true. That said, I would be remiss if I didn't say that they're better if you go to Idaho or Wyoming. You don't want to come to Montana. Those places are far better. And so I can.
This is the introvert in you speaking, right? You don't want people coming and moving around you, right?
No, that's right. And I think all my friends locally will get mad if they hear me publicize in Montana. So. Anyway, it's been a great move for us. It really worked for my kids and the school and their lifestyle, and we're really happy. And look,
are you all remote? Are you all work from home then? Is this a virtual company now, or was it always like this?
No, we are. So this was a decision we made there. And look, as exciting a company as we are, competing for talent in the Bay Area is tough. We also have a large operation in Pittsburgh, and the pandemic kind of made clear for us that we can thrive in this remote environment. And so for us, it's really opened up the ability to recruit people all across the country. And so in the last year, we've added, 150 folks from all different parts of the country, and really brought in some incredible talent to the business. And so for us, that's really the biggest driver, is just the access to incredible people, that being a remote company enables, and I guess I'm leading by example being here.
Michael, this has been great. I appreciate the time. Thanks for joining with me today.
Yeah, thank you, Eric. Appreciate it.
Thank you to my guest, and thanks for listening. Subscribe to get the latest episodes each week, and we'll see you next time.